All right, guys. Thanks, guys, for jumping in. I know it's 8 o'clock at night on Eastern Coast, so we'll try to be as respectful of your time as possible. But first off, just want to wish you guys all happy holidays and thanks for jumping on. We're pretty excited about this presentation. We've been working on the revamping of SIH for 2-3 years now. We originally launched this fund when COVID started, when interest rates were 2-3%. So some of our rates at that time, we were competitive for that time. Things have changed, but at the same time, we purchased a couple of single assets that took our time and attention to the operational side. But now we're at a stage where they're pretty stabilized, those assets, and we have a chance to refocus on this income fund. It's a pretty small fund. We don't expect it to be open for a very long time, but we did want to make some improvements to change with the times. The other big thing that I wanted to point out is the name of the fund. We did change it because Anthony's company, KW Holdings, merged with my company. SIH used to stand for Shapiro Investments Holdings, but we decided as we merged that we were going to keep the SIH, but going forward, SIH will be known as Strategic Investment Holdings. So the Shapiro is out of it, and then Anthony's officially part of our partnership now. So those are just a high level before we were going to get into it. This income fund is a 506c offering. Almost all of our other deals are actually 506bs, but this one we did start early on when SIH didn't really have much of an investor base. So we did start it as a 506c, but now, so it's still a 506c, but just wanted to let you guys know that. And almost all the pictures in the deck are going to be properties that Anthony and I own or are partners in. The one right here, this is Oxford Village. This is our affordable housing, which is our core competency. But we'll show you some other properties as we go through with the deck. So the usual disclaimer, I'm not going to read every single word for it, but again, this is not financial advice. You should always consult with your professionals. This is a security, all investments have risks type of thing. This is your standard disclaimer. Any PPM that you've ever seen has language like this. So I'll let you guys read it on your own thing. I will send out the webinars. I'll actually be posting the offering memorandum in the deal room in the next day or so. So you'll be able to go through this in more detail. So just high level table of contents. We're going to be going through some of our team, where we have been with the fund, the differences going forward with the new fund, some of the projections that we're expecting, and some more miscellaneous items. And we're going to just wrap it up with a Q&A. And by all means, throw the questions into the chat. We might not get to them right away, but at the end, we'll nail every single one of them. So just feel free to post it in the chat or the Q&A, and me and Anthony will be monitoring that. The category we're going to be dealing with is the executive summary. Just a quick introduction about me, Dennis Shapiro. I wrote a book, The Alternative Investment Almanac. We broke the $10 million assets under management. Again, we're not capital raisers. So these are $10 million that we are actually managing from an operational perspective. Some of the projects we have is the affordable housing projects, which is a unique niche that I think we focus on. We do have a short-term rental community in the Jersey Shore. That's actually where I live. And then we also have joint ventured on some self-storage projects, as well as some traditional multifamily housing. So I'll pass it along to Anthony to introduce himself, and then we'll go to the next slide.
Hi, folks. I'm Anthony Kahn. Dennis and I have been working on our properties for the past few years, actually, now. And one of the major things I wanted to also mention was we were able to start our property management company last year, and that's been an incredible way to start improving your net by reducing expenses and really controlling them, and then also taking control of our revenue. So that's been a huge help. We're through all the properties that are the fund's already working with. We have multiple partners. It's an excellent backing system that's been created as well. So working with Dennis, having him as a backup, even for myself, I can just mention how great that has been at times. So I've been in project management and program management the past 20 years, and it's been now full-time with the real estate. So I've worked across 5 different industries, and program management into real estate transitions really well. We, as Dennis mentioned, the affordable side, that's what our Affordable Housing Redefined is, our property management company. So as we keep taking on more assets, we're able to manage them ourselves, which really creates efficiencies and allows us to control that net income. So that bottom line, for our returns. So that's been a fantastic change over the past year, I got to say.
Yeah, so even though there's only two people on the slide, we do have a property management division that's headed by John. So if anybody's seen the Oxford webinar, John Suarez is our president of our property management company. He's got over 500 unit experience. And then we have property management under him. So it is larger than just the two of us, but we are the executives when it comes to SIH Capital Group.
All right. So when you think about the investment, some of the key parts I want to mention are, of course, solid returns. That's one of the most important reasons why you're looking to invest. And then stability in multifamily, especially. That's one of the most stable assets you can invest in. The fund itself, instead of being tied directly to one property and one outcome, you're going to be able to have that diversity of multiple assets and investments. So it creates an even more stable return with the income fund. Capital preservation is huge because you could put large amounts into the income fund and have that returning on a solid basis. And one of the most important things about real estate is inflationary. It has an inflationary hedge. Over the years, one of the biggest investments for the wealthiest people in the world is real estate. So you have that as our inflation hit 16, 17% the past 2 years, our rents have gone up. Of course, expenses are going up too. So it all goes up in parallel. We weren't hurt by an 11% inflation that we had over the past few years in a single year. Dennis and I were talking about, we have that between us and also for investors. And it's not just one person, you have ourselves and then our teams to back everything up as well. So it's a solid group of people working together to make this happen and also back each other up. Sorry, Dennis, you wanted to add on?
Yeah, so I want to give a little bit context on this. So when SIH first started, we were mainly LPs, and there's nothing wrong with that. It's a very viable. The only thing is, after a while, you start realizing how many sponsors were more marketers than actual specialized in actual operations, especially when you look at any deals that went full circle in 2017, 2018, 2000. You start realizing a lot of them played games. I call it the flipping, commercial real estate flipping, where they would just go in, renovate 5 to 10 units, go ahead and then give it back to the broker that they just overpaid on. And the broker would then go and grade a fool and sell it to the next grade a fool. So there were a couple of things that we were starting to pick up, and we still have some LP investments in the fund. The fund was launched during COVID, so we started with just purely LP deals. We do think that they are exceptional LP deals, but at the same time, we realize that no one's going to be more accountable than ourselves. So every project, we had a inflection point where every project going forward with the income fund was going to be where we were going to be accountable to ourselves, have our own property management company in place. So the last thing we wanted to do is, and if anybody's ever invested more than 3 deals, any deal that ever goes bad, they'll always say, oh, it's the property management's fault. And we had a pinky swear promise type of thing saying, hey, we're never ever going to use that, because you can't use that if you have your own. So we figured out, like, how do we create a property management company with only 72 units? That was our 2023, like, how do we do that? Because everybody says you need 1,000 units. How do we do it with 72? And we need to do it so we could get more accountability. So that's a lot of the accountability. Also really key is in the last 3-4 years, you had a bunch of creative cash flow deals. I've invested in some of them. They don't involve real estate per se, but they have super high returns. And surprise, after a few years, this one was a Ponzi scheme and this one is in litigation. So part of this income fund's growth is realizing, hey, I am perfectly fine with a portion of my fund being a portion of the fund's income being produced by hard money, private lending, and then a portion being produced by equity. Yes, I might not get that super 20, 25% return of capital in year one, but you could look at that portfolio, you could see exactly how it's structured, you could figure it out, and you could rest assured that it's nothing too creative where you need a third party to audit it or anything like that. It's usually, I think we have something like 5 or 6 assets. Probably with the next raise, we might go up to 7 or 8, but it will never be 100, 200 assets. And it will be all assets that we going forward would be operating in some shape or form. So that's just a little bit of the origin story. And in terms of cash flow, we've actually been able to pay the full pref ever since we ever launched with the income fund. So it was 7% when we first launched. And I think we are at something over 30, 32 distribution straight. We're never missing a full payment. And that's just because the focus always has been income, and it's been very effective for that. So I'll just wanted to add that. So
And
Anthony, can you talk about the key facts about our fund?
sure, I'll do that. And exactly what Dennis just talked about in the project management world, we call that managing your risk. So by taking control of all these things, we reduce our risk of having anything else happen. So it makes it even more stable by running it ourselves and having our own management. So it's that solid returns and stability are even better. So some of the key facts about the fund, and some of the folks who've been invested since 2021 know that there hasn't been any distributions missed, and we're going to continue down that path as we keep going. The classes are changing slightly. So what we have now is a $50,000 one where it's going to be up to 8% now. And then the class B, when you invest 250,000 or more, it's going to be at 9. And for class C, it's going to be anything at 500,000 and above at a 10% preferred return. The asset management fee will be 1.5%. And that'll cover all the management related operations. So we're not going to add any additional fees on top of that. That's basically to run everything. As we close deals, we're not going to say, oh, we're going to take X amount more percent. No, this is how it's going to run. The portfolio itself, since 2021, it's been running. And as I mentioned, there's been consistency of delivery on a monthly basis for all the distributions happening. Dennis is going to talk more about the mix of investments that are currently there and what we're planning to go towards, like he was alluding to. And it's going to be more real estate focused going forward. There is an ATM fund that's going to be tailing off in the next few years here. I'll let Dennis dive into that next. Next
and just want to clarify. So the 1.5 is all encompassing. So there won't be no transaction fees, no capital returns fees, nothing like that. We did want to keep it pretty simple and just incorporate everything into one. Also, the minimum investment has gone up. Originally, when we started, we did $10,000 investments. The problem with smaller investments, we love it because in one way, we loved it because it created trust and allowed someone to come in with a really low cost. The problem was it was very hard to place that capital right away. So we had to wait until other investors got in. And that's why with 50,000, we could place that pretty quickly and easily. So that's where some of our thought process is with some of these changes. So this is where the portfolio is today. It is a large chunk in multifamily. One of the reasons is because we were investing in some of our own deals. For example, the income fund invested in Oxford Village, which was our affordable housing. Mobile home parks and self-storage was done through a fund, a multi-asset fund, pretty well-known operator that I've had on my webinar plenty of times. And then multifamily, we also had a limited partnership deal with a company called Praxis, which we've had Brian on multiple times. And then the ATM fund, which played a key role when we were starting out because it created that extra kind of cash flow coming back going forward. And it's not that I have anything against the ATM industry. I've written chapters about investing in the category or not. I just think there's some auxiliary investments that are related to ATM funds that have not done fairly well and had certain parties involved. And I don't want to just keep investing in the same thing, because at the end of the day, you're putting your money in trust with an operator that you don't really have a relationship with. Almost everybody that's involved in ATM investing does it through one operator. Unless you have a personal relationship with that operator, you're not really going to have that foresight to be able to know when things can go bad. And one of the most famous ATM investors even says there might be a 3-year period where in 3 years, this investment is completely insolvent. So there's reasons why we're stepping away from it. And our goal is to go from this, which had the ATM exposure. The development deal, the 5% development deal, interesting enough, was a deal that turned out to be a Ponzi scheme. So there's multiple reasons why we're moving that going forward. I published learning lessons from that deal, and that was also part of the accountability where we wanted to get out of there. So that is what our portfolio looks like today. And then this is where we're going to go with this fund going forward. We believe that the income fund should focus on the cash flow as well as appreciation. We think there's some significance of doing both. I think there's a lot of funds out there that just are 100% debt. And there's nothing wrong with it. They usually are super liquid. The problem is there is a certain element of safety that a good equity deal can provide because of that back end return. So it can take a lot of pressure off the debt if you have good equity deals maturing inside the fund. So that's why I'm a firm believer in not just doing 100% debt. So our goal is to do 50% hard money lending. Now, this has been a really long endeavor. Part of the reasons why we've been waiting so long to do this change is that we wanted a good source for hard money loans that we had operational involvement in. Now, that's not our specialty. So we found a partner that we've done a few deals with. We really have a great relationship with. And what we did is we did a joint venture where SIH Core is actually part of this operator's fund, and where we have operational insight. We could approve every single deal that ever gets lent out. But now it's that kind of accountability that we've been asking for. And now that we have access to his deal flow, we're going to incorporate that, and we're going to go a certain percentage into the fund for that. The rest is multifamily. We still operate our own deals. We don't do 100 deals. We're definitely quality versus quantity, at least in my opinion. So we're going to have an opportunity to keep selectively buying. Like, we're currently in the process of buying a 60-something unit portfolio in Ohio that's pretty close to us. And we are strategically looking to add to the portfolio. But again, they'll all be on the general partnership side of it. Mobile home parks, we have a couple strategic relationships. I've had them on webinars. We have an operator in PA and an operator in New Jersey that we've had advanced talks with, where we would also be on the operational side. So we do expect to have opportunities like that in the near future. Self-storage, we currently have one deal with the self-storage space. We expect to potentially do more. And then short-term rentals. We think short-term rentals from an income fund, not in the traditional sense. We have a couple of people in our network that will go in and they will buy a property really cheap, fix it up, and then almost like a hard money loan. But we have the relationship with them where we could do a hard money loan with them with a equity kicker. And it's the equity kicker that I think is so interesting for the income fund, because the hard money loan lending by itself will produce what our goal is, but it's the equity kicker. And if we could assemble 10 to 15 of these deals where we get traditional hard money terms, and over the course of 3 to 4 or 5 years, we've also gotten an equity kicker in 15 deals, we think that's pretty lucrative to the portfolio. So the investment,
Yeah, sorry, if I could just mention also with the real estate loans, now that also takes a bit of pressure off. If you think about other capital raisers, what they do is they get all this money, they have to place it somewhere. They're pressured to actually place it because they have to do something with it. With the real estate loans, these are 6 to 12 months or maybe more if we want to, contracts that we're putting in place. And that creates a bit of versatility in how we want to and picking the right deals to invest in. So we're never under pressure to have to do X amount of deals per year like other capital groups where they really literally have to, otherwise they're going to have to give the money back.
Yeah, and I'll just mention our total deal size is 5 million, and realistically speaking, we could be very choosy for that amount. You got larger funds, they're in the 30, 40, $50 million range. They really need to put that money into circulation. We don't, and we're probably not going to take capital unless we have deals. So we might just say, oh, you're interested in investing 50 to 100,000. We'll line up an opportunity and then we will request the money. We're not just going to put it in the account to let it sit there and not actually earn any money. So it's a great point, Ann. Thanks. So I want to go over a comparison of where we were. So again, we were relying on ATM funds and the development funds. They did at one point produce some significant cash flow. But again, like the development fund, it produced a 10% preferred return, and there was supposed to be an equity kicker. But at the end of the day, without the capital preservation of that deal, it turned into an absolute awful investment. So that's why we're removing development funds. We are phasing out the ATM funds, and we're really just going to focus on private lending and good old-fashioned multifamily. We think there's some beauty in the simplicity of just doing that model. So currently we have about $500,000 on the assets under management. We are co-investors in this fund. At the time of the presentation, we had 26 consecutive distributions. And at that point, it was just I was the lead operator on this. So our upgrades, the biggest one is Anthony joining the team. If anybody's ever known Anthony, he's one of the most analytical people I've ever met. I tend to have a high vision and to put together a plan and go. Anthony's the guy that kind of actually makes sure that plan is actually detailed enough. So we make a really good team when it comes to that. Again, the other big thing is the hard money joint venture fund. I didn't want to just take my money and put it into a debt fund that I have no access and no operational input on. That was a really big and hard thing for me to get done in the last 2-3 years. The greater focus on our own deals. We're phasing out ATM investing by 2027. And then I don't know if we're still going to go through with it, but we did want to get to the point where any capital that is sitting there, we did want to try to get them into savings accounts and money market accounts. At one point, they were paying close to 4 or 5%. So we did want to look into that potentially there to just reduce that drag that sometimes you get in capital. So this is, again, it's the same offering. It's just a re-amended PM, same accredited investor. The total returns are 8 to 10. So this is where I want to take a minute and kind of explain. The way that we're structuring is that basically 100% of all the money, except for the asset management fee, goes to the investor up until their full pref. And then once they get their full pref, then 100% waterfall basically to Anthony and I. And we feel that aligns really well, where we could focus that, hey, for the next 5-6 years, Anthony and I might not see a penny of it besides the asset management fee. But we know if we could keep plugging away equity deals, we're going to be fine in those 5 to 7 years. But at the same time, we've provided a great cash flow for our investors. We will still always offer individual deals. Like we have that Ohio property that's coming up. That will be a regular syndication. You can invest in there. That total returns, what we usually project 13 to 15%. You could get all of that upside. However, this is less risky. It's a fund, and you're going to get 100%. There's no 70, 30, 80, 20 up to that pref. The goal is to really get you as close as possible to that pref. Is it perfect? Probably not, just like any other investment. But the goal is for us to really focus in on getting you your full pref. And if you get to the $500,000 range, that's the first 10% of that money is all yours. The other big difference is we are introducing limited liquidity. Now, again, we're not a fully liquid in year one like other debt funds. The only reason why is because we do have equity deals. So the funds have to come from the investments. They can never come from another investor, obviously. So we expect that if we could get to that 50% allocation within a certain time frame, let's say 2 to 3 years, then we can start offering at least some liquidity starting in year 3. So that would be our goal for the next 3 years, is really to weigh heavier on hard money lending, which comes back quicker, so we can provide liquidity for our investors. Now, this isn't 1 day liquidity, this is not 1 month liquidity, but we do expect to introduce an element of liquidity into this fund. That's been something I've been working on, figuring out exactly how to do that. And we are a closed-ended fund, so there's no open-ended. So once we fully raise and in 2 years, 3 years, someone wants the liquidity, that's not like money we could just go and raise it from someone else. So we are mindful of all of that. And this is the compromise that we came up with. So again, the fund size is 5 million. We're already at 500K. So we'll be raising 4.5. I don't think we're going to raise it all up front, because that will put a lot of pressure on the returns. But we are definitely going to be we're going to be raising it in batches as we get the hard money opportunities and the equity opportunities. So the asset classes we're going to invest in, and this is actually pictures of our short-term rental community that we have in Bradley Beach, by the way. So just in case people are wondering where those pictures are from, the only assets we're going to be really simple: multifamily, self-storage, mobile home parks, and hard money loans. That's it. No more ATM funds. No, you won't find any unique mineral rights or anything like that. It's just those categories, and that's it. The 3 classes are A, B, and C. Again, there is no projected returns above these numbers. The goal is to give you 100% priority for your cash flow needs. And this is not a total return play. This is strictly a cash flow income play. How we evaluate our equity deals. So this is something that we're pretty passionate about. Anybody that's invested in any one of our deals, we did have a deal that had high construction, and we did need to do a variable loan on it. But 99% of the time, we are going to be doing fixed from day one. So having long-term fixed debt, I think, is the number one thing. Almost every single deal that has gone bad, besides being an operational problem or a natural disaster, has gone bad due to financing. So we are firm believers. Set up your financing to put you in a position where you're not forced to ever have to sell. And that's a rule that I've learned from one of my mentors, and I try to keep that on. The next thing is we try to underwrite 13 to 15%. I'm not going to use the C word because everybody always does, and it's a pet peeve of mine. But that's another thing I learned from my mentor: never underwrite for 18, 20%. You're just setting yourself up for failure. So almost all of our deals, you'll see that 13 to 15% number. And if we can't get there, then we don't put an offer in. It's pretty simple on that. Operational control. This is something, besides a handful of general partners these days, we are probably only going to be investing in ourselves. And if we ever have to choose between, investing in ourselves or investing in another operator, we're 9 out of 10 times going to choose ourselves. Operational alignment. This is an interesting one. And this has become very trendy now, but I feel like we've been doing this for the last 3-4 years, is make sure that your operator has that 10-year horizon. That's what we have. So we wouldn't even consider investing. The mobile home park operators we mentioned, I don't think I've ever heard them ever actually sell a deal. So those are the kind of operators we want. We want the Buffett types, hold it if it's a great asset, pay fair price, hold it for the rest of your life type of mentality. And then property management, we have developed a strong preference of in-house property management. We tried the third party for a very short time. It was a complete disaster, but I am thankful that it was such a disaster that it just forced our hand into probably skipping 3 years of our original timeline. We had a 5-year vision of having our own property management company, but it was so bad that we did it in 9 months.
Yeah, I'd love to mention that too, because it was a property management company that I was working with for, 4 years before. And they were doing fine, but then it was just the amount of volume they started getting and a lot of people leaving, and they couldn't handle the volume of properties. And it was a very good thing to happen, because Dennis said it forced us to do some hard things, which was starting a property management company, hired the right staff and all that. But wow, it really propelled our revenue and the property a few years. When Dennis mentioned the investment return profile, that 13 to 15% is just, that can happen with just a few of the levers actually hitting, but we have at least say 5 different levers that we can pull to make the returns work. But just we go conservative and think worst case scenario, maybe only 2 of these things out of the 5 are going to work out. Can we still get there? And so that's the way we look at this. We're not looking at it like, we're counting on appreciation to happen. We're counting on other things out of our control to happen. So when we're looking at the properties, we conservatively underwrite. So that's why he was saying that 13 to 15 also.
I also mentioned on the property management side, we do have partnerships in the mobile home park space, self-storage space, and these aren't brand name operators. All of them, we've actually had masterminds together on property management, and all of them are vertically integrated. And that's something that we're very passionate about. And usually the operators that we are networking with are equally as passionate about their in-house property management. Oxford Village. So this is a great sample equity deal. So we purchased this March 18th, 2022. So we're about, 18 months on this project. We bought it with 10-year fixed debt at 3.83. Right now, we're averaging about 4 to 6% on distributions. We finally are seeing a clear path. 9 months of that was probably due to poor property management. Once we took it over, a lot of that was also because this is affordable housing and we were dealing with delayed housing authority, rent increases. But either way, this deal penciled out really good and it's aging really well. We're now at pro forma year 4 rent numbers, and we're only 18 months in. So we're going to start seeing that cash flow really start increasing. We are the lead operator on that. And the 3 general partners on that deal invested close to 40% of their own money. On 40% of the entire equity of their was from us. So we have a high conviction, obviously, in our own deals. And Affordable Housing Redefined is our property management arm. How we evaluate debt deals, again, it's all about collateral. This is something that I've learned on some of my debt deals. We really try to, there's been loans that we've loaned for $25,000 and there's been $80,000 worth of equity on it. Those are the type of deals that we are looking for. Obviously, that's probably an outlier, but you almost want to not root for a default, but default actually creates a huge windfall. You lend 180, but the property is worth 230 easily. So in that case, okay, go ahead, default. You're going to make an extra $50,000. So we never invest in a deal that doesn't have the proper collateral. That's number 1 rule. We are looking to get 12 to 15% on our money with the hard money lending type of thing with points. And then lien position is super important. We want to be in first position or in second position only if the LTV is a no-brainer, if it's at 50% or 40%, something crazy. And then we want working relationships with the people. So we're not expecting to lend to 1,000 different flippers. We want to have our core batch and just take it from there. So financial analysis, so pretty simple. We do expect a cut to the cash flow if we do get a wave of money coming into the fund until it starts picking up again. We went over the different thresholds, A, B, and C, the thresholds for that. So I think we went over this in debt. I'm not going to go crazy on these, but this is the range we're expecting to get into before tailors off and more of the equity starts appreciating and comes back in. The other thing that I want to mention is we're in a really sweet spot for equity deals. I think we're in contract right now to purchase something in January. We just purchased something in October. Both of those deals have been seller financing that don't have prepayment penalties. So deals like that set us up pretty well to refi out compared to 2018, 2019, 2020. When you're purchasing properties for 3-4%, it is very hard to justify a refi 2-3 years later if the rates are 4.5, 5, 6. However, in today's environment, if you could get the deal to pencil out at 6.5, 7%, and we are potentially at the top, I think Anthony sent me a CBRE report that showed that the rates are projected to start coming down at the end of the first quarter of 2020. If you're at that cusp over there, and if you time it correctly, and yes, you get into a bunch of deals at the 6.5% rates, you're not guaranteeing, but you're increasing the likelihood, the fact that you will have a choice of at least doing a refi. And it's not just talk to make your IRRs look better. So I think that's pretty important. So I think we're going to get into a situation with this fund is that if we are doing some equity deals with the hard money lending, I think there's a pretty good chance that 2-3 years down the line, you're going to see several refi events coming in. So that's B, C, and you guys can look at these later. Additional avoiding bad investments. So between the general partners, we have about 40 plus years. And we actually have, I don't know, I think I've invested in one Ponzi scheme. And then the second one right now wasn't a Ponzi scheme, but it was a bad apple. Everybody is liable from time to make a bad investment. But the key is, like Ray Dalio says in Principles, is can you look back at it and, okay, can you create some principle rules that you're not going to break going forward? So this is a slide that I really love to present on, because this is everything that I've invested in those 40 years between me and Anthony. We put this together. So the one thing you should always avoid, I think, is a quick capital return. And it's sometimes hard because you have an income fund and then you're going to compare it with an alternative investment, let's say mineral rights or oil and gas, and they're projecting a 20-25% return, blah, 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 blah. I think the question you got to ask yourself sometimes is that if those returns are that much so early on, why do they need your money? So I think that question has to really sink in on some of these investments, and you see them over and over again. And ATM fund investing, I would say, is not that there, but it's almost on the fringe of those type of early on returns. But there is a portion that they're paying back in principal as well. So it's not quite as high. But just when you see investment offerings and they project these huge first year returns, and they start 3 months later, and you're going to start getting, such a large portion of your capital back. And they even justify it, and they even label it as, oh, so much of the risk is coming off the table because you're getting so much of your money back early on. You just have to ask yourself, if that's the case, if they're producing a 20-25% IRR, why do they need your capital at some point? Are they making 40-50% on your IRR on your money? So those are the things that I want to really sink in there. The other thing is evergreen structures and complicated portfolios. There's a huge difference between looking at a portfolio that has 6 investments and that has 60. It's just the nature of high numbers kind of skews things and starts to become diluted at some point. The other thing is evergreen structures. If anybody's not familiar with it, those are open-ended funds. And I think one of my favorite quotes from a securities attorney that I talked to was, no one ever starts off intentionally trying to do a Ponzi scheme. Ponzi schemes happen because an operator falls behind for whatever reason, and instead of admitting it, instead of fessing up for it, or whatever it is, or they're diverting cash for their own personal luxurious lifestyle, whatever the reason is, they start using the other investors' money. And what happens is, and this is something that I came across during my research, it's not that all evergreen funds are Ponzi schemes. There's some really great operators out there that have evergreen funds. The problem is, like 99% of the Ponzi schemes that I researched were evergreen funds, just because of the fact that the money was going in and out. And whenever you have investor cash coming in and out, it creates a disconnect, because the number one rule about investing is that the cash flow coming in should be buying an asset. And whenever you have money coming in and out, it's very difficult to trace that. Versus, let's say we raise $250,000, we get the commitments, we actually have to go place 250K of assets. And unless we do that, we're not calling in our 250,000 because we need them to match up. And if they're not matching up, then there's a problem. So always make sure that whatever investment you guys look at, make sure that if I'm putting in X, can I see the X assets that it's purchasing? And it should be very simple for that operator to show you that. Otherwise, that's a huge red flag. Tax benefits over state. Yeah, go ahead.
I'd like to mention 16 years ago, I watched my dad and my family, we lost all our savings in a hedge fund that was a Ponzi scheme. Same thing. It wasn't ill intentions initially, but when the tide went out in 2007, my dad had retired. And then for me, I was younger and losing all my savings. It was easy to build back, but for seeing that happen to my dad, that pushed me to real estate. And it was a evergreen fund. It was diversified in the hedge fund. Unfortunately, exactly what you're talking about happened. And the tide went out in 2007 and they got caught with their shorts down. And a lot of people lost. It was over 100 million. So lost.
Yeah. And it happened. And I think the Ponzi scheme that we invested in was over $2 billion. So there is no shortage of bad actors out there. Always be careful, but these are the rules that I think can help you avoid them. The last two is the tax benefits overstated. I think that's a big one, especially when you get into October, November, December. You start seeing this left and right about these tax efficient thing. I know sometimes with the natural resources ones, you get to be a GP for a year, all of that type of stuff, and then you could offset your active income. Just be careful. At the end of the day, you should be investing in the asset because you think it's a good asset, not because the fact that you're going to get a tax benefits. The tax benefits is a bonus, and it shouldn't be the primary reason, because even if you save 20%, honestly, if you have 100% capital loss, what's the point? So always be careful when the operator is really singing the praises of tax benefits. The last one, this is something I think I became more familiar with when I got into the operational side of things, is too many capital raisers. I've seen this a couple of different times, and you start seeing the same, like different capital raisers all of a sudden start. And this is a good example of the ATM fund. There was 18 different capital raisers for the ATM. They're just putting their own label, but then it's the same type of fund. You're getting that in the car washing space these days. Almost every week there's a new operator getting into the car washing business. I've seen this in a different short-term rental model. I started seeing a plethora of capital raisers pop up overnight. And in order to be a capital raiser for a deal, you didn't need to be a registered investment advisor, or you need to be really a general partner on the deal. So you always have to question that. And like, where's this coming from? How many GPs do they have? All of those kind of things. So just always be wary about if there's too many capital raisers involved. So risk mitigation, inflation environment, I'm pretty happy to say that we're 100% fixed loans at this point. At this point, we're probably not going to be doing any bridge loan deals ever again, just because it doesn't tie into our philosophy. We are buy and hold guys, and bridge loans are not really buy and hold. I think I had Brian Burke on for the webinar, and he gives an amazing presentation on why you should be a 3 to 5 year guy. And that's his philosophy. He lives and dies by it, but he can understand it. He can explain it. So many other operators are just doing 3 to 5 because it just pencils out better and it's easier to raise capital on it. And they're trying to get in and out as quick as possible. So again, we're really going to focus on the fixed debt. On the debt side, we're really going to focus on the collateral. And then bad operators, we're avoiding them because we're really going to be self-managing most of these deals. And this is part of the reason why this fund is only $5 million, because there's only so many deals that we could effectively manage before there's a loss of quality. I mean, Anthony, we have these conversations of how large of a team do we want, and we don't want a large team because we like working with each other. But once you have a team of 10, 20 people, there's going to be people that you don't like working with. And we didn't leave our W-2s to work with people that we don't want to work with. So this is our philosophy on that. So next steps, if this is something you guys are interested, reach out to us. We're currently doing the deal room in our portal, Invest Next, so that we will have the PPM, the webinar, the whole 9 yards. And also just reach out to us. Either me or Anthony we're more than happy to answer any questions you guys have on the fund. This is a nice picture of Oxford Village as well. And then I'll leave it there and then just open it up to any questions. Sorry if this was a little long-winded. And this is going to be recorded, so we will share it. If there's any questions whatsoever after listening to it again or whatever the case is, by all means, ask it anytime that you guys are ready for it, and we'll get back to you on it. All right, guys, have a great night.
Thank you, everyone.